Hey, hi everyone. So today we are going to go through about trust and how a trust could be used for tax optimization, and which are the places for best places for forming a trust, and how trust could be formed by individuals and companies for tax optimization. So that's the topic for today. So what is a trust? A trust is a legal arrangement where a settler, who is the creator of the trust, transfer the assets to a trustee to manage on behalf of the beneficiaries. Okay, so like the rich people in the world, they can form a trust and put a trustee and transfer their assets to the trust, and the beneficiaries would be their children or grandchildren. Okay, so that's a traditional trust. And if they are minors, someone is managing that money for them and giving a small share of them for their expenses. So that's what a trust is. So where a creator transfers assets to a trustee to manage on behalf of beneficiaries. It's widely used for estate planning, asset protection, and tax structuring. What are the best jurisdictions for tax efficient trusts? Are generally these trusts are formed in tax haven countries because these places are mostly favored because there is no income tax, capital gains tax, or inheritance tax in those countries, uh, and there is a legal recognition of trust in those countries, and strong confidentiality and protection laws are there in those countries. And what are these countries? Cayman Islands is the first one. It has no income tax, no capital gains tax, and it's popular for hedge fund structuring. British Virgin Islands is the next one. It's famous for confidentiality and tax on trust income. Isle of Man, it has a strong trust law and no capital gains or inheritance taxes there. Jersey and Guernsey, so this is reputable for wealth structuring, compliant with EU laws. Singapore, benefit is tax exemptions under certain trust types. High legal clarity is there. Dubai, DIFC, flexible trust law is there. Zero tax environment is there. Mauritius, trust with non-resident beneficiaries can be tax exempt. So, what are the legal mechanisms for reducing tax using trusts? Income splitting could be done. So, a trust can distribute income to beneficiaries in lower tax brackets. Like, suppose the beneficiary is a minor or a retiree, whatever is zero tax bracket, that amount only could be distributed to the beneficiaries. And this income splitting is common in Canada, Australia, and UK under certain limits within the lower tax brackets is common. Okay. Second thing is deferral of tax could be done. So income retained with a discretionary trust is not immediately taxed in some jurisdictions. So the tax is deferred until income is distributed. So if you have some stocks which you bought and long term you're holding them, their price is increasing, their value is increasing. Unless you sell them, there's no tax on it, right? So that's what it is. So tax is deferred until income is distributed, until you sell it and make money out of it. That tax is deferred. Okay, non-residents trust. So if a trust is non-resident for tax purposes, example, set up in British Virgin Islands or Cayman or managed offshore, it doesn't pay taxes on global income. Okay, that's a advantage of non-resident trust. You could will not pay any tax on the global income. Dynasty trusts are also there, which is in the US. Example Delaware and Nevada. These places you can legally bypass the estate taxes for multiple generations up to 1,000 years in some states. Asset protection is there again. This trust will shield the wealth from lawsuits, creditors and divers, especially in Cook Islands, Nevis, and Belize. This trust will protect the assets for future generations from lawsuits, divorces, and creditors. Yeah. So, what are the examples of trust use for tax planning? Is example one is offshore discretionary trust could be set by a high net worth individual, and it could be set up in British Virgin Island or Cayman Islands, and it holds investments, basically some stock investments it has, and it receives dividends and interest it receives. Okay, if it is a bond, it will receive interest. Okay, and if it's a company, it will receive stock dividends. So yeah, Set up an offshore discretionary trust in British Virgin Island or Cayman. Whole investments receive dividends and interest. Beneficiaries would be global family members. Income taxed only when distributed, if at all. So when profits are distributed, then only the tax will happen. Otherwise, there will be no tax, only on dividends and interest. These dividends and interest are also not taxed in BVI and Cayman Islands. That is one example. Family trust in India or UK, you could put. So Indian promoter sets up a private family trust in India. So it would be a pass through of capital gains to family at individual tax rates. So you'll have individual tax rates whenever income is distributed to you. The gains are distributed to you. Individual tax rate will happen. Okay, no corporate taxation will happen or double taxation on dividends will happen in this scenario. Singapore is also Section 13 X trust is there. Singapore trust holds global equities, for example. This income from the global equities is exempt under Singapore tax code, but the trust has to have a licensed fund manager to meet compliance. So this is what trust, how trust could be used for tax optimization, and okay, and what are the best places to put a trust, and what are some of the examples how trust could be used for tax optimization. But all in all, this is just an explanation, overall high level, what a trust is for tax optimization. Yeah, that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye.